Good evening and welcome to the John F. Kennedy Jr. Forum. My name is Blake Barclay, and I'm a first year who plans on studying religion and economics at the college. And I'm a member of the JFK Jr. Forum Committee here at the Institute of Politics. Before we begin, please note the exit doors, which are located both on the Park side and the JFK Street side of the forum. In the event of an emergency, walk to the exit closest to you and congregate in JFK Park. Please also take a moment now to silence your cell phones. You can join in the conversation tonight online by tweeting with the hashtag Glauber18Forum, which is also listed in your program. Please take your seats now and join me in welcoming our guest, Sir Paul Tucker, and tonight's moderator, Mr. Robert Glauber.
Good evening. I'm Bob Glauber. I'm a member of the Center for Business and Government here at the Kennedy School. And I'm most happy to welcome all of you to the annual FINRA lecture on financial regulation and to introduce this year's speaker, Sir Paul Tucker. I also want to welcome our guests from FINRA, who are the sponsors of this. And where's Robert Cook? Is he here somewhere? There you are. And thank you very much, and thank you, FINRA, for sponsoring this each year. For those of you who are going from here to Fenway, there'll be blankets and hand warmers right outside at the door for you.
One of us is badly connected.
Yeah, I think so. And I think it's I.
Might be mine.
Who knows? Paul Tucker served as Deputy Governor of the Bank of England from 2009 to October of 2013, which was right in the middle of the financial crisis. He was at the center of worldwide efforts to contain the crisis and reshape the international regulatory framework to enhance financial stability. He brought to these tasks 30 years of experience at the Bank of England, and I will tell you we are all most fortunate to have him so deeply involved. And importantly involved in these efforts. After Paul's leaving the Bank of England, we are at the Center of Business and Government, Kennedy School, were the great beneficiaries of attracting him to join us as a senior fellow. In that role, he greatly enriched the intellectual life of the center, and from time to time appeared in many classrooms, including the classroom of the course on regulation of capital markets that Hal Scott and I teach. Presently, Paul is chairman of the Systemic Risk Council, which is an independent body of former top central bankers, government officials, and financial experts engaged in policy recommendations to achieve and maintain a stable financial system. He's a director of Swiss Re, which of course is a global insurance company. He is an associate of Harvard's Center for European Studies and a visiting fellow at Newfield College, Oxford. Most recently, he's the author of a very interesting book, Unelected Power, The Quest for Legitimacy in Central Banking and the Regulatory State. The book examines the extraordinary power of central banks, what are the benefits from fostering independence for that power, and how can it be shaped to provide legitimacy in a democratic state. Paul served at the Bank of England for 30 years. During his early tenure, he led staff teams on monetary policy strategy, market operations, financial stability, and was a line bank supervisor. Following the '87 stock market crash, he was seconded to Hong Kong and its financial market regulator to help reform the securities markets, which had suffered tremendous disruptions during the crisis. During his leadership years at the bank, he participated in and led a number of global financial regulatory committees, including membership on the steering committee of the G20 Financial Stability Board, chair of its committee on the resolution of cross-border banks, director of the Bank for International Settlements, chair of the Basel Committee for Payments and Settlement Systems. He really is, and it's a title that's used probably much too often, he really is a central banker's central banker. because he has the experience and the depth and the wisdom, as well as the education and the broadness to do the job that needs to be done by a central banker. This evening's Paul's topic is reinforcing financial stability in a crumbling international order. My intention is that after Paul has made his remarks on this topic, and before I open up the questions from the floor, I'd like to pose to Paul a couple of questions which arise from his current book on the power and legitimacy of independent regulatory authorities. It's a very good book and a most timely one and an important set of issues that we really shouldn't allow Paul to get out of the room without answering some questions. So with that introduction, I'm simply delighted to introduce Sir Paul Tucker and hear his remarks this evening. Thank you. You got to work.
Is this working? Maybe I don't need it anyway. Bob, thank you very much. Should I use? Bob, thank you very much indeed for asking me to give this lecture. 30 years ago, almost exactly 30 years ago, Bob Glauber had just finished writing what was the Brady Report in this country on the stock market crash in 1987. It was during that process that I met Bob Glauber. I was on the other side of the world writing a report about how Hong Kong had fared during the stock market crash in 1987. It actually had the worst of the stock market crash. Its clearinghouse went bankrupt, its futures exchange closed, its equity markets closed, all its capital markets closed. That prompted accusations of corruption in its securities regulators. It was completely redesigned. The Brady Report is really excellent. You did a great job. We were hugely relieved that it was out before we had finished. I don't know whether the Hong Kong report was any good or not. What I do know is that the Hong Kong securities markets are still structured around the recommendations that we made 30 years ago for good or ill. It's a treat after 30 years that life brought us together again here and speaking here this evening. Bob was kind enough to mention a book that I've just got out on the legitimacy of independent agencies, things like the Fed, the SEC, and other agencies like that. I am contemplating a second book about international institutions, and what I'm going to do this evening is try and weave together two strains of thought. The one is, does more need to be done to make our financial system safe and sound? And secondly, how much more difficult will it be to do that given a crumbling international order? The burden is actually in the second part of the talk. The issues in the first part of the talk about the financial system, the examples are plausible simply because I can pretend to know about them. But actually, if a crumbling international order threatens cooperation in the financial regulatory field, it would threaten it in other fields as well. So what we have learned over the last 10 years is that financial crises are very, very, very costly. It starts with financial costs, it spreads to macroeconomic costs, it spreads from there to social costs, from there to political costs, with a small p, in the sense that parties lose elections because of the economic costs of financial crises. But from there you get cultural change and you get constitutional costs as well. And you don't need to be as great a student of the Great Depression as Ben Bernanke and others to understand that great financial crises are very, very costly indeed to our societies. And therefore there is a kind of premium on somehow avoiding them without suppressing the dynamism of the economy. And no one knows exactly where to make that trade-off. How safe should we make the financial system? If we could plan it ideally, would we take risks where the next crisis might be in 150 years, or do we want to push it out to 500 years? And are we prepared to accept the suppression of financial activity that would entail? What I think we do, and I don't know the answer to that question, and what's more, I think that's a question for public debate and for politics rather than for people like me. What we do know, I think, is that a system that continues to rely on regulators setting minimum equity requirements for banks and dealers will eventually fail. That there will be another financial crisis at some point, and that therefore we ought to do a better job of coping with financial crisis when it happens. And I think we could do probably quite a lot better at that, but it would require considerable more reform, some of it requiring changes of law, some of it requiring central banks to reorient themselves a bit. The first would be that the central banks and regulators would say, to the extent that you as citizens and small and medium-sized businesses have a demand for safe assets, money-like assets, we are going to stand more firmly behind those money-like claims that you hold. So what this would mean concretely for those of you that follow finance is that the central bank would say, we will lend against a certain class of your assets, subject to a discount, up to the entirety of your short-term liabilities, or spinning that round, your short-term liabilities may not exceed your capacity to borrow from us against a certain class of assets subject to a discount. There'll be some of you in the audience that know that Mervyn King has pushed that idea. Actually, the idea in my country comes from a man called David Rule, who fortunately is still embedded in the Bank of England. This would be, and if that sounds, well, isn't that what we do? Well, at the moment, the requirement on banks is that they should cover their retail deposits with liquid assets to the extent of about 5%. So not the other 95%. I mean, there's a bit of waving hands there for some of you that are technicians in this, but not much, not much. We have basically decided that retail bank deposits are sticky. I would just invite you to look at the British BBC coverage of the run on Northern Rock. Retail deposits aren't sticky once people decide that they might not get their deposit back. Now, what I've just described doesn't work at all when a bank is fundamentally insolvent, because that amounts to the central bank bailing out the short-term creditors at the expense of the longer-term creditors. Well, you can deal with that up to a point, and you can make banks issue bonds that can be converted into equity and absorb more losses in circumstances like that. But what if the requirement you have set for these bonds, they're called bail-in bonds, and I'm associated with them, wasn't sufficient, that the distress in the firm exceeds both the equity and these bail-in bond creatures? Well, then you're going to go into bankruptcy and ordinary creditors are going to get hit. Well, what happens then, at present, is that if you were a creditor of a bank because you had been providing catering services to the bank, or you had been providing limousine services to the bank, or cleaning services to the bank, or if you were a derivatives counterparty that had got a collateral with the bank in the form of a, quotes, deposit with the bank, or if you were a small business with a deposit above the insured amount with the bank, or if you were a senior bondholder with the bank, you're all going to be treated in exactly the same way by the bankruptcy trustee. And I want to suggest to you that if and when that happens, as it will, politicians won't like it at all, because they will want the person who provides cleaning services to be treated very differently from the person who, or the investment institution that has bought a bond in order to make money. The cleaning service provider is owed money because they've provided something in return, a cleaning service. The bond person they're just trying to make money by lending the bank money and enabling it to lever up. Now, we could only get around this by being more prescriptive about the creditor hierarchy of banks and institutions like banks. And up to a point, Europe has done that in a very small way. Now, that's enough about the details of finance. For those of you that are involved in finance and financial regulation, all I want you to think is that or something like that, or some other thought that you have, might make the financial system more resilient without adversely affecting economic growth in a material way. That's all I need you to take away from that. And the reason for giving those two examples is that I supposedly know about this stuff, and therefore these are plausible examples that policymakers might consider. So here's where it gets interesting. Pretty well, all of the financial reforms in this country and elsewhere after the great financial crisis of 2007, 2008, 9 were agreed internationally, not agreed within the circles in Washington, not agreed in the circles in London or in Frankfurt or in Paris. When Dodd-Frank was going through, Senator Dodd said to me on one occasion, so this must be in 2010, he says, I want you to understand, Paul, that we know that we are basically tracking what the G20 are prescribing and you guys are discussing in an outfit called the Financial Stability Board. Don't think that we don't know that. But you need to understand that in terms of the politics, it has to be presented as though it's entirely a domestic initiative. And exactly the same is true in London or elsewhere. And in the very long run, I don't think that is the best way. I think that's the best resting place. I think it's quite a good idea that the citizens understand where their laws are coming from or where the ideas are coming from. But I don't think we should pretend the world is different from the way it is when you're trying to get difficult legislation through Parliament or through the Congress. The challenge is, could we do anything like that in the world that confronts us today and is in unfolding? And it's worth emphasizing that this cooperation in 2008, 9, 10, 11, that wasn't new. Post the Second World War, after the relaxation or the unraveling of the Bretton Woods fixed exchange rate regime, there has been intense international cooperation. So many of you will have heard of this thing called Basel, whether you know what it does or not. Basel's interventions in banking were caused by the failure of a bank called Bankhaus Herstatt, a German bank in 1974 that had no operations in the United States whatsoever, but created quite a clatter in the United States because it had done Deutschmark dollar transactions where it was going to receive Deutschmarks and it was going to deliver dollars, and while during European banking hours it received the Deutschmarks and then it went bust, and so it didn't receive the dollars that were due to be delivered during American banking hours. And the central bank governors and others realized in those circumstances, we're affected by each other's banking standards. We have a collective interest in ensuring that all of our banks meet a minimum. Although at least we should know what each other do. It didn't get much further than that then. In the mid-1980s, Paul Volcker, when he was chairman of the Federal Reserve, approached the then governor of the Bank of England to try and develop the first capital accord, because the Fed had got a problem, and we had got a problem given the development of derivatives and off-balance sheet finance. And Paul and the people working for him in the Fed wanted to do something about that in their banking regulations and said, well, if we do this just in the US, everything will go to London. We need to ensure that London does it as well. And so we agreed to that. We thought that was a good initiative. And then actually they discovered that our way of doing some other things was slightly better than their way of doing things, which on that occasion it was. And we agreed a bilateral agreement. We then brought the Japanese in. We then took it to Basel, and it became the Basel Accord. I can't think of a single thing in international banking regulation of any significance in terms of safety and soundness that has not been international, either in conception or execution. And believe me, since I'm speaking in America, American policymakers will systematically have you believe something different, just as they would have you believe that the rescues of 2009 were all designed in Washington and weren't the product of meetings with capitals in Europe. So those are my assertions, and here are now my speculations. How would all of this work under 4 scenarios? And one of the things I want to ask you is, are these the best scenarios, or are they terrible scenarios? And have you got better scenarios that we should be thinking about in terms of guiding the international institutions over the next few years? One is that there continues to be a dollar-based system dominated by America as the world's leading superpower. The second is that we move to, however soon, 20 years, 15 years, 30 years, these are short time periods, a multi-power top table where quite a few people sit at the GX, United States, China, India, some form of unified Europe, conceivably Indonesia, conceivably Brazil, or some subset of that. And that's a kind of peaceful accommodation, a kind of balance of power world in some way. The third is that there are rival reserve currencies and rival dual superpowers, the United States and I guess most obviously China, in a tense standoff that spreads through almost every walk of government life imaginable. And the fourth is protection and autarky. And the thought that lies behind this is as follows, and there are some very distinguished policymakers in the audience. We have all basically worked in a world where the sphere of geopolitics and foreign policy and security and the sphere of trade policy and the sphere of international monetary and financial policy live in parallel universes, but each to some extent depending on the other, and certainly the second and the third depending on peaceful accommodation in the world of security and foreign policy. Well, you know, we can't be guaranteed that over the next 10 to 20 or 30 years, or perhaps in the next 5 months, really. So let me take the first. And in each case, I'm going to say something about banking policy. And to the extent that you're interested in other elements of policy, just do the thought experiment for the area of policy that you're interested in. So dollar dominance, but with rivals emerging. I would suggest that the Federal Reserve needs to be more accommodating in agreeing what are called swap lines with other countries. These are arrangements where the Federal Reserve will agree to lend dollars to a foreign central bank against the security of their currency, so as to enable the dollar to be used in that part of the world and to help the central bank of that world bail out or support its local banks. During the crisis, the Federal Reserve and the ECB, the Bank of Japan, the Bank of England, the Swiss, all entered into swap contracts. And obviously, this was the Federal Reserve providing dollars to the rest of the world. I would say this is a precondition of being the supplier of the world's dominant reserve currency. the Federal Reserve turned down India. The day the Federal Reserve did that, I remember when I heard it, we weren't involved in the consultations, I remember thinking, oh, mistake, and buzzed, staff come through to me, and I say, you've got to find out whether this is absolutely done and dusted and go and see Mervyn immediately and speak to X in the Treasury. These people may not have realized that India is a rising power. This isn't 1975. I think the world I'm talking about, the Federal Reserve would prudently be slightly more open about that. Underline the slightly. I'm going to ramp that up towards the end. I think US regulators would be slightly extraterritorial in their approach. I guess in 2011 or 12, I was in a G20 policymaking meeting, and one of the US agencies was describing essentially the extraterritorial approach or reach of their market regulations. What this amounted to was that if somebody in Melbourne did a transaction, and somebody domiciled in Melbourne, operating from Melbourne, did a transaction with somebody in, let's say, Manila, domiciled in Manila, in a European security that was denominated in dollars, the American authorities would claim jurisdiction over any relevant aspects of the trade. And I say in this meeting, be careful, because people will reciprocate this. Somebody in Michigan may do a trade with someone in Massachusetts in a European equity denominated in a currency from Asia, and a great capital city in Asia will claim jurisdiction. And you will need to think there is a difference in being the only hegemon, where you don't need to think about reciprocity. And I don't think the officials concerned had thought about this at all. I absolutely do think that the Treasury Secretary of the day had thought about it, not the one actually who just left, but he would have done too. I think that it's a world where the US authorities would be prepared to use sanctions, but would use them very deftly and delicately, and having thought through all of the angles. This is exactly what Treasury Secretary, former Treasury Secretary Jack Lew argues in a recent Foreign Affairs article. I think the IMF, in applying conditionality in its programs, would be less keen to say you should restructure your economy so that you look more like either the US or the UK, again, so as to avoid a world where somebody says, well, actually, you should kind of look like a different form of economy. But I think banking policy would probably carry on much the same in that world. Now, what about a kind of multi-power, top-tier balance of power world? I think this is a world where you can imagine there being one leading world reserve currency, the dollar, but lots of really big regional kind of hub and spokes system almost, but regional hub and spokes. That would be a world where each regional leader entered into swap lines and supported the people around it. Banking policy would probably be made at a GX table, where X doesn't yet exist, where there would be potential competition to peel off the satellites from each regional leader, and where the IMF would retreat somewhat, because regional solutions would be found things. If there was an equivalent of the Greek crisis, that would be regarded as a European problem, given that the euro area doesn't run a collective current account deficit. And so global institutions would retreat somewhat and would have a residual world somehow between these great blocks. The next one, of course, is slightly more difficult. Rival world currencies in a tense world. This is a world of geopolitical competition in absolutely every sphere. This is a world in which, and I said this to Janet Yellen once, I don't think she agreed, but disagreement is good. This is a world in which the Congress could flip, I don't say would flip, from the Federal Reserve is very bad when it enters into swap lines with other countries to provide dollars, to being very keen that the Federal Reserve enters into swap lines because it becomes an instrument of foreign policy, where some central bank from the other side of the world and the Federal Reserve and the Treasury go knocking around the world, knocking on doors around the world, saying, would you like a swap line from us? So as to encourage their local banking industry to be dollar denominated in part or in the other currency, and so as to support, in a kind of very broad mercantilist way, American business and other businesses that use the dollar or the other currency. This is a world where sanctions would be used to protect the members of one's own bloc against the members of the other bloc for kind of economic type violations as well as security type violations. It's a world where, to the extent that there was still trade between the blocs, there would still be some collective policy making, but it might be pretty minimal, and banking policy might be done for one block over there and for another block over here. And if that sounds fanciful, then I'll go to the final scenario, which is protection and protectionism and autarky. This is where sanctions are used as a weapon, where banking is weaponized as an instrument of foreign policy, where banking policy is set entirely within the hermetically sealed blocks. Now remember that the Soviet Union, none of the countries of the Soviet Union bloc were members of any of the international organizations or active participants in any of the international organizations I was talking about earlier, and didn't become active participants in them until the early 1990s. But remember also that the Soviet Union did hold dollars, and it held them in London, which is really interesting, from the late 50s and 60s onwards. And I don't know this as a fact, but it seems to me that it must be the case that the US had acquiesced in London, allowing the Soviet Union bloc to hold dollars in London. Why, by the way, were the dollars held in London rather than over here? Oh, because the Soviet Union trusted our courts over your courts, which is, well, certainly our courts are very, very good, and we have dignified judges. We don't have law schools either, actually, which is a very interesting thing. So I think, why am I saying all of this? I think that this intertwining of spheres, geopolitics, foreign policy, trade, which I haven't got into this evening, monetary stuff, banking policy, it comes around so rarely that people aren't trained to cope with it, but it does come round. People think of the famous Bretton Woods event as a monetary conference held up in New Hampshire, but it was a geopolitical and trade conference. Secretary of State Hull wouldn't let that meeting happen until my country had agreed to basically disestablish imperial preference in the sterling area, and there was later a compromise on some of that. This was part of the post-war monetary arrangements were absolutely predicated upon a handing over of hegemonic power from, or recognizing the handover of hegemonic power from London to Washington, and that world trade would be organized differently in consequence. When Bretton Woods unraveled during the 60s and finally in the early 70s, that too was a geopolitical moment. When President de Gaulle of France asked for his gold back, here's your dollars, give me the gold, this wasn't just an act of monetary policy. This was a little time after Suez and a little bit before France had suspended their membership of NATO. And of course, it was a signal that France didn't believe that America could finance the Vietnam War without inflation. That bit turned out to be right. And if you read anything about Paul Volcker's career, you get a picture of a man who was steeped in foreign policy meets monetary policy. And because this comes around so infrequently, I would suggest to you that there is almost nobody in high office in our monetary or banking regulatory institutions who has any conception of what it would be like to face a geopolitical moment or a shift of the foundations of the kind I described. And that description would certainly fit me as somebody who had never confronted it, but I'm not in office, so it doesn't matter. Thank you very much.
Listen, people are going to want to ask you a large number of questions based on that. But before I let them do it, what I would like to do, as I said a few minutes ago, is ask you a couple of questions that grow out of the book you've just written on basically Fed and other agency independence and how one legitimizes that, whether it's important. So let me start by asking those questions. The whole issue of Fed independence has obviously been very much in the news recently. President Trump very directly told the Fed what he thought they should do about interest rates. And interestingly enough, Paul Volcker recently recalled having been told pretty much the same thing back in the 1980s. So this is nothing new. President Trump isn't going down a new path. My question, Paul, is why is central bank independence so important and worth working so hard to defend? After all, these are unelected officials of great power operating in a constitutional democracy.
I'm going to have to pick up the mic.
I guess we'll give you a mic. Yeah.
I'd like to find a way to your question by first of all saying something about President Trump's public remarks on the Federal Reserve. If I were the head of a central bank and a government wanted to put pressure on me, I would be thankful if that happened in public. And I don't think this has been said enough over recent weeks. It's easier to shrug off if it's in public, which is your duty, but it's also that people will actively come and support you. And in those circumstances, you want the battle to rage, kind of without you having to speak. The story about Paul is much more insidious. And I think people should weigh this in thinking about what's going on at the moment. So the story is that we now know that Paul was asked to go to the White House to see President Reagan with Jim Baker. And it was not in the Oval Room. And people have speculated that that's because the room they were in perhaps doesn't have tape recorders in. And the president didn't speak, as the story is told, but instead Jim Baker says, I order you not to raise interest rates. Now, I know Paul pretty well. I'm very grateful to know Paul very well. I didn't know that story before. I know other stories about his conversations with presidents, but I didn't know that one. I think that's more troubling. More troubling still, and we know exactly what happened with this. In the early 70s, Arthur Burns was regularly summoned in to see President Nixon. He was quite close to Nixon. He was on the Nixon wing of the Republican Party. And Arthur Burns was doctrinally, he was no softy on monetary policy. He was one of the teachers of Milton Friedman. And a remarkable thing happens, which I talk about in the book, and I'm very, very harsh about Arthur Burns, who I think was a disgrace to his office, but with peculiar mitigating circumstances. The tapes, the White House tapes, in one of these conversations between Nixon and Burns, has one of them say, the election's getting close, we need to get this economy going. It is Arthur Burns speaking, not the president. But before that, the White House had been running an operation where they told the media that Arthur Burns wanted a pay increase, and the media ran a lot of stories about this. Became a big story in the United States, that Burns was in office and was just constantly trying to get a pay increase. And Burns took a lot of big hits in the public sphere through that, and it was untrue. Now, I think what he should have done is he should just come out and said they're lying. But it's not easy. I was chief of staff to a governor of the Bank of England that came under pressure like that, and it is not easy to know what to do when it is not directly aimed at you in public. Why does this matter? Very briefly, it matters because it's hard. There isn't a constituency out there in any of our societies for high and variable inflation. High and variable inflation hurts just about everybody in society, certainly people on lower incomes or in less secure jobs. And yet it is hard for anybody running for political office to commit to low inflation, because in the short run you can always do a little bit better by boosting the economy and letting inflation rise, and with it the jobs will rise temporarily, and then inflation will get out of control and you'll have to slow the economy down, and no one's any better at the end than they were at the beginning, except that you got yourself re-elected. And Paul Volcker cured that problem over here in the 80s. We didn't cure it in the UK until the 90s.
Okay. So Fed independence is important in your view for the reasons you've said. The Fed now has a much bigger role in financial regulation than it ever had before, both micro-regulation and systemic regulation, macro-regulation. Got it. Can I take this off? Yeah. Good. So my question is, do you think that larger role in regulation jeopardizes the amount of Fed independence?
No and yes. So I don't think the system here is as well designed as it could be. I think it is a mirage, that's not quite the right word, but it would be a phantom to think that central banks will not be involved in the stability of the banking system. So I can think of 2 G7 countries where under the law, the central bank is not the bank supervisor or regulator, Germany and Japan. In both cases, they are intimately involved with it. I once said to a former president of the Bundesbank, Helmut Schlesinger, that name will be known to some people here. The significance of Helmut is he is absolutely the dominant spirit of the Bundesbank over the last, 40 or 50 years. Why don't you want to be the banking supervisor? And he said, because we get blamed for it, and that would taint our reputation for monetary policy. And I said, but most of your people work on banking supervision, which is more or less true. Certainly a lot of them work on it. But that didn't shift him. Now, I have 2 things to say about that. First of all, in 2007, and in the 10 years before 2007, the Bank of England was not the supervisor or the regulator of UK banks, and did not protect the Bank of England reputationally from the hit when the crisis came at all. And that was a deeply painful moment for all of us in the institution, but particularly for the governor of the day. Central bankers cannot protect themselves from the reputational hit, because in a financial disaster they will be at the scene providing liquidity and can't insulate themselves from it. If they're going to be involved in handling disasters, as they will be, then they have an interest in having some influence over knowing about the banks and having some influence over what is required of the banks. Schlesinger would travel with me so far on those bits. And then I would say, and this is kind of what my book is partly about, I would say our modern democratic rule of law values say, and if you have those responsibilities and powers, they should be formal, not informal. You should be accountable for the great powers that you have, rather than it just being done in the mode of some medieval guild.
Okay, let me move you from the Fed one last question about this whole issue of independence to a different U.S. regulatory agency, the SEC. How would you say its independence stacks up against the Fed's, and why is it more or less independent? It doesn't matter.
So, rather oddly, for US legal scholars, the SEC would be described as an independent agency, and that's because its leaders have what's called for cause protection, which means that the president can't get out of bed in the morning and say, I don't like the look of this SEC commissioner, they're fired. President Roosevelt tried to do that with a commissioner of the FTC. Well, actually, the man had passed away, and they refused to pay his pension, and it went to the Supreme Court, and the Roosevelt lost. But the SEC and the CFTC, the Commodities and Futures Regulator, and many of the other commissions have to go to Congress each year to get their money. And so they are not insulated from politics. Big picture, I think that is a good thing for the following reasons. The SEC has three objectives, which broadly speaking are protect investors, promote capital formation, promote efficient markets. Each of those is obviously vague. So protect investors, how much? A lot? A bit? How much does a lot mean? A lot? That's something that they have to decide. Congress gives them that discretion. They also have to decide whether to put the weight on investor protection or on capital formation. You have just seen, with the change of president and the change of leadership, a shift in emphasis. That's a world where, if you're making, these are choices of high policy. These aren't choices for people like me. That they have to go back to Congress for their money each year, I think is good. But, and it's a big but, this makes the SEC pretty ineffective as in ensuring the stability of markets and the stability of the financial system. The US regulatory system is poorly designed. What we did in the UK, and my book is partly a justification of my thinking that went into that, is the financial stability body has the power to give directive, which is completely independent, has the power to give directives to the market regulator on issues of stability, not at all on issues to do with investor protection or capital formation or efficiency. And I just think it's very hard for Congress and the American system to do subtle institutional design, but it ends up with institutions that either have a legitimacy deficit or leave the people of America with a welfare deficit. And it isn't beyond the wit of woman and man to design a better system, which Paul Volcker's now been saying for about 30 years, I think.
Others have too. With that, let me open up the discussion to those of you here in the audience. Let me just again ask you to introduce yourself and ask a question. Good. Yeah. George? Yeah.
Yes, my name is George Hogue of Chesham Investments. One of the scenarios that you outlined was a world of competition for reserve currencies. And my question is whether, in fact, this is a suboptimal world. The idea being that competition leads presumably to policymakers and markets enforcing on policymakers better macroeconomic policies, assuming the policymakers think that the benefits of being a reserve currency outweigh the costs.
Well, it's a great challenge, of course. There was a bit of care in the scenarios in that the peaceful scenario was a multi-tier, multiplayer top table of 3 or 4 or more, whereas the rival reserve currencies world was a bipolar world. I guess I am not an optimist about a bipolar world that is orderly and peaceful and not a contest. And let me give you one could give security foreign policy examples of that, like around the South China Sea. If Monroe Doctrine for the East, why not? there are good reasons why not if you're America or Europe. But let me give you an example from the monetary sphere. So the articles of the IMF, the International Monetary Fund, provide that the country with the largest economy, they imply that it's entitled to the largest quota. And they also provide that the country with the largest quota is entitled to the headquarters of the IMF. So you can imagine a world if China catches up in GDP per capita terms, China's going to be vastly bigger, and the headquarters of the IMF would move to Beijing from Washington. Except that I've missed out the key bit, which is the votes on whether or not to change the allocation of quotas depends in part upon the current quotas, including congressional ratification in this country and elsewhere. So it seems pretty unlikely, actually, that the great capitals of the West, including the one here, but not only here, are going to agree to a shift of the IMF headquarters to Beijing, and China having the veto over IMF policy in the way that the US has a veto over IMF policy. Now, you can imagine two ways through that. One is, oh gracious, stalemate, we need to reach some accommodation and actually redesign the articles altogether, and so that there is nobody with a single veto. Or you can imagine a standoff. You can also imagine circumstances, by the way, which in those circumstances, for those reasons, because the same would apply to the World Bank, by the way, that the United States of America will become very keen on European unification, so that its core ally has one unified vote in the IMF and other global organizations. Whereas, of course, the current administration prefers bilateral negotiation with European countries. Beijing has made it clear that they prefer bilateral negotiation with European countries. So I'm trying to conjure a world where things become fairly complicated, and that the kind of game theoretic way of thinking about monetary regimes isn't going to be the dominant consideration. It's going to be power.
Paul Sheard from the Mosavar Rahmani Centre for Business and Government. I'd like to go back to the start of your lecture, Sir Paul, where you talked about the importance of the lender of last resort, a function of the central banks. And I think most economists, would judge that the ability of the central banks to act as a lender of last resort was really critical in the financial system and making sure it wasn't much worse. But the lesson that was drawn in much of the public and political sphere was sort of the reverse, that bailouts were bad. And what came into effect was rather this idea of having resolution mechanisms, orderly liquidation authority in Dodd-Frank, for example. So I'd like to get maybe a two-sided question. What do you think that central banks can do, and governments more generally, to sell the idea of the importance of a lender of last resort function better? And secondly, what are your thoughts on how effective a so-called orderly liquidation regime would be in an actual financial crisis, and how those two functions, lender of last resort versus resolution regimes, could actually work in practice?
Okay, thanks, Paul, and I'm sorry I wasn't at your talk on QE the other day. I think I was at Rutgers. So, what's the best way into this? I think the best way for central banks to get, in this country especially, to get a more balanced debate about their lender of last resort responsibilities is to embrace and proselytize the importance of resolution. Fairly or unfairly, and I don't know the truth of it, the Federal Reserve is perceived by some people on the Democrat side and some people on the Republican side to have lent to fundamentally insolvent institutions. Some people who hold that view think that the Fed exceeded its legal powers. Some people who hold that view don't think that the Fed exceeded its, actually I should say, and some people think that it exceeded its powers and that was a fine thing. Some people think that it exceeded its powers and that was a terrible thing. And some people think that it didn't exceed its powers, but nevertheless it shouldn't have been in the business of bailing out firms. And I have said repeatedly, and will continue saying this, that I think every time a central banker gives a speech about lender of last resort, and I think they should give more, I don't think they talk about it enough, is they should start off by talking about resolution policy and how they will not lend to firms that they know or should know, reasonably should know, to be fundamentally insolvent. And the reason for that is that when you lend to somebody that is fundamentally insolvent, that is when this epithet bailout is appropriate, because you are enabling the short-term creditors to escape, but you enable the long-term, you may leave the long-term creditors worse off. Let me give you an example for everyone that isn't an inside baseball person. So I am the short-term creditor, and I have a claim of 50, and Bob is the long-term creditor, and he has a claim of 50, and this institution's in a terrible mess, and it turns out it's only got assets of 50. I'm not going to give Eric's not going to be the central banker because he's a really good central banker. There's some central banker out there who says they will lend to the bank, and the bank, they give the 50 of assets as collateral to the central bank, and the bank uses the 50 units of currency to repay me. Because the bank is fundamentally insolvent, it goes into bankruptcy. The outcome is, I've got my money in full, Bob is left with nothing. Had we gone into bankruptcy at the beginning, and of course I'm ignoring transaction costs and bankruptcy costs, we would each have got half of our claim. The big thing that's going on here, for someone that wants to think about it, is that there is time subordination in life, but not in death. That when a firm goes into, if we are ranked the same, we are alongside of each other with it exactly. In fact, the liquidator, the bankruptcy trustee, may not pay out to me without paying out to Bob, Parry, Passu. So central banks should not be in that business. And resolution, if it works, can relieve them of that burden, and the central bank should just be prepared to put the institutions into resolution. Now, I've spoken enough. I think these resolution things can work, but if they can't, I think the Fed should be screaming, and the Bank of England and the ECB should be screaming from the rooftop, because part of the political difficulty they are in is a perception, I repeat, fairly or unfairly, of an abuse of lender of last resort powers. Every time a central bank, let me crystallize it this way, every time a central bank is described as having bailed someone out, they need to be able to say in good conscience, bailout is the wrong word, and then name the senator. And they need to be prepared to do that in public, but they need to have backed that up with internal processes and speeches and principles, and I think that was harder to do before the crisis. I think it is easier to do it now. I think it is in their interests to do it, and I wish they would.
Paul, you've just... Thank you. Paul, you've just illustrated a general principle I've observed over several decades, which is that people on your side of the Atlantic are much more freaked out about moral hazard than people on my side of the Atlantic. Let's leave aside, and I understand it's a big leave aside, the politics. You described a situation where things worked out, that the central bank got fully repaid, in your example, and the short-term creditors got out in full, and the long-term creditors got hammered worse than they would have been. Suppose we had a regime where that was kind of how it worked,
And everybody knew we had a regime where that was kind of how it worked, that there were going to be a lot of situations that were going to involve ambiguity, that it was really catastrophic when these things got busted, and central banks were going to lend money into those situations, and it was going to have the effect of skewing the relative interests of different creditors, and everybody adjusted themselves to those rules. Why would, and if it's really right that, for example, the letting Lehman go in an ambiguous situation had catastrophic consequences, if you had used an example where the central bank hadn't been able to get itself fully paid, I would have understood your argument better. But if all it did was skew the interests between one class of rich guys putting money into this institution and another class of rich guys putting money into this institution with some prospect of greatly mitigating the consequences, I can't imagine why you would be hugely fussed about changing that.
So this is a variant of what I think of as the Hamiltonian Democrat argument, where I should emphasize that Democrat has a small d rather than a big D. So let me go back to that example. So in the example I've just given, the central bank kind of knows that the institution is insolvent. The other one is that they don't, and Bob's claim is now a 6-month claim. It doesn't go on for years and years, but it's still more than sight. And the months pass, and 6 months in the context of the latest crisis wasn't long at all. And they lend to Bob as well, or they lend to the bank, and the bank pays out Bob as well. And then the central bank discovers that actually the collateral is worth hugely less than they thought, and the central bank loses money. And so then you get the question, what are the political costs of losing that much money? But either is a kind of fiscal question. And I would meet you, I'm not sure it's halfway, but a bit of the way, which is if someone said, we are going to provide, we, the elected people, Congress, Parliament, are going to provide a regime where the central bank can lose X much money in the pursuit of stability defined somehow or other, I think that could be perhaps reconciled with our system of government. What I think cannot be reconciled with our system of government is I sit there and think, oh God, these parliament people and cabinet people, they're all hopeless really, because this isn't just a point about the United States of America. I'll decide just how big a loss Bob should take, how big a redistribution I do. I decide how big a loss I, as the central bank, am prepared to take. And the significance of this, I think, the difference between me doing it or, I don't know, the UK Treasury doing it or the US Treasury doing it, is I can't reverse it. So the thing about a fiscal thing, if I think of Chancellor of the Exchequer in the UK, they could, if they don't lend to Bob loses money as a long-term investor, but the Chancellor of the Exchequer has tools where he can compensate Bob in some other way. And for political scientists, they can make side payments to Bob. I can't do that at all. But where I think we are completely halfway with each other is, or at least I hope we are, is it is unsatisfactory for this to be fuzzy, and it ought to be clear where central banks stand on this. I mean, if you're completely right, it ought not to be possible for people in Congress to criticize Ben and others without them being able to point to something and saying, we were just doing what you told us to do.
So I'm still surprised. So I would make 2 points in response to what you said. One is Professor Summers' policy on makeup exams is fuzzy. he kind of pounds his fist a bunch about how they're not going to be make-up exams at the beginning of the semester. And then some kid's sick and they got a sad story and it's really going to be terrible and they're not going to graduate. And he says, fine. And he lets there be a make-up exam and tries to say he'll never do it again. Yeah. And actually, after 35 years of thought as a teacher, I have concluded that providing a precise roadmap on the circumstances when there will be make-up exams would be an active mistake, and that the correct way to manage that problem, or the related problem of when a government should pay ransom, is with ambiguity. So I'm surprised that you're as opposed to ambiguity as you are. I'm not surprised because I've heard you before, but I'm unconvinced by your attachment to clarity. And the second point is that in the actual problem, and I actually engineered a change in IMF doctrine for this reason, normally these kinds of loans would be made with a premium interest rate. Yeah. And so it's one thing to kind of plan to lose money because you're lending money at your borrowing cost and you're not sure it'll get paid back. It's another thing to have a policy which is circumstances with ambiguity will present themselves, and we will charge a risk premium that, in our judgment, will on average cause this activity to be profitable for taxpayers, but there will be particular instances when it will turn out not to be profitable for taxpayers. Now, I understand there may be a lot of problems of perception, but I do think that central bankers seeming legitimate and popular is one value, and protecting against depressions is another, and I kind of would put more weight on the second. So I think you need to recognize also the element in the calculus represented by the risk premium on the interest rate should cause you not to be quite so horrified by losses.
Okay. So I'm going to start with the second one and then try and remember the first, because the first I'm going to argue that the analogy doesn't work for significant reasons. So on the second, so you introduced a third term, which of course you knew, which was there's curing depressions and maintaining legitimacy and popularity, and I am not arguing that central banks are in the popularity business. Indeed, I think it's really important that they're not. And I think it's serious when members of Congress or members of the Parliament feel that they've gone beyond their powers. So I think there is a need for clarity around their powers. Now, more importantly, so I don't think the analogy works. And this is for reasons about communities. So the world that you're describing, even Harvard, is quite small. Actually, the world of the IMF, of states or finance ministries representing even 180-odd countries, is quite small. And so the kind of relationships, the possibilities of trust in a smaller community are more consistent with the exercise of discretion than the possibilities of trust in very large political communities. I mean, the reason that Madison argues for some of the structures that you have, which are really quite complicated, and one of the reasons we don't have them is that we're smaller and have a more kind of organic history, is because you can't rely on trust in governing a territory as large as this. You need to draw lines and have checks and balances. And so the question about the exercise of discretion by unelected power holders is whether they're essentially stepping around that. So my response to you is exercising discretion in that way. God, I should hope so. I haven't been a university teacher, but I would intuitively agree with you. I think within the organization I help lead, we exercise discretion as managers and leaders quite regularly. I think doing it at the level of the central bank chose to bail out the people in Dakota, but not the people in Illinois, or the balance of people in Dakota, and not against the interests of the balance of the people in Illinois, is a bit less likely to be understood given the looser bonds of community. That's the best I can do.
I actually would like to get into the debate as well, but I'm going to resist and call on another.
Oh, sorry, it's my turn.
Perfectly right.
Thank you very much. My question is about the relationship between macroprudential policy and financial stability. It could be a question for both Bob and Paul.
Micro or macro, an I or an A?
And the question is, how crucial do you think could macroprudential policy for financial stability? It seems that the UK has taken a bunch of measures of macroprudential policy, but on the contrary, the US has done almost nothing on that. Thanks.
Well, big picture, you're right. That's not an accident because the Dodd-Frank Act was passed in 2010. The thinking in official circles hadn't got as far as articulating what later became called macroprudential policy. The legislation in the UK was passed in 2012. By then, more of that thinking had been done, but not completed, and there are ambiguities and, for what it's worth, deep policy issues embedded in that regime that will end up being confronted over the decades to come. The big thing is make sure your financial system's resilient, and you don't need what's called macroprudential policy for that. You just need to be really focused on making sure the key parts of your financial system are resilient, and ask whether they can withstand the kind of shocks that are going to occur, whether it's a cyber attack or countries going bust or whatever. And actually, the leaders in macroprudential policy, leaders sounds as I'm saying it's good. Those most active in macroprudential policy have tended to be the most developed emerging market economies, particularly in East Asia. But in many of those economies, it shades sometimes into trying to manage the terms of trade. So there's, in a kind of competitive way. So, and I don't think the IMF has gripped that at all effectively. So we're getting definitely inside baseball here. I think it's better to hold on to, make sure your financial system's safe and sound, decide what you mean by safety and soundness rather than leaving it vague.
My name's Laura Nicolai. I'm a junior at the college. So since the crisis, banks have done two things, well, more than two things. But first, they've drastically decreased their reliance on short-term funding in the US. Yep. And second, they hold a lot more reserves now, of course, which pay interest now. And particularly reserve balances are concentrated amongst a few large banks, and in particular to meet high-quality liquid asset requirements under the LCR requirement. So do you see any risks to financial stability coming from monetary policy as the Fed continues the balance sheet reduction process and drains the supply of reserves? Given that background, are you concerned at all about that going forward?
This is a great question. It's a really brilliant question. I was debating it in public with Randy Qualls, who's one of the new vice chairs of the Fed in Stanford a few months ago. So you are right that banks have reduced their reliance on short-term funds. That's partly because they were scared, for what it's worth. I mean, others here will have had an experience like this. Of all the really big banks and dealers in the world, the CEOs of all of them kind of caved in personally while it was happening. I don't think I personally would be any different. Only one of them kept their head in the face of the worst of the storm. So I think they've learned that they shouldn't, one of them said to me, but we thought we'd got lots of liquidity and then we hadn't got any. And they were talking about something like 60 billion. I mean, it sounds like a lot of money, and then it wasn't at all. So I think that will wear off over time. The liquidity ratio that you referred to acts as a Pigouvian tax, and so incentivizes them to spread out their maturities. That's for the good and part of the attention. But the reserves thing, they've got loads of reserves because the Fed has been buying loads of stuff, or my old shop has been buying loads of stuff, and whoever they buy it from, it ends up with the banks holding more reserves with the Federal Reserve, and that makes them super liquid for the time being, and that will go down over time. And I don't think there's any magic in this. I don't think the Fed should pick a number of the level of reserves that the banking system should hold. But I hope they will run down that bond portfolio. I'm changing the subject slightly, but there are some people, including some people in Harvard, who think that, oh, great, they bought all this stuff, it helps save the world. Now what can they do with it? They could use it to kind of make markets more efficient. And consistent with my earlier sentiments, I want them to get back to as small a balance sheet as they can possibly have. For what it's worth, I think that will be much bigger than at the starting point. I haven't really answered your question, and that's because I will only learn the answer over the next few years.
Yes, hello. My name's Anselm Danica. I'm a grad student here, and actually one of the roughly 800 people working in banking supervision for the German Bundesbank on leave now. So it is actually a lot, and more than the ones working on monetary policy.
I'm right about that, aren't I?
Yeah. And much more as compared to BaFin, actually.
Yeah.
But my question is on something entirely different. I had the chance to hear your first talk also, and now this one. It's pretty much on sort of how the two relate to each other on central bank independence and sort of the future of the currency order. Because if I understood you correctly, you said if we want a smooth transition, it would be nice to have all these swap arrangements act more cooperatively between central banks. And then when you look at essentially the other issue, if I understand you correctly, you want to have more mechanisms of accountability and transparency and make central banks a bit less independent. And just looking at what happened after the last crisis, the way Congress reacted to the international swap lines was essentially a backlash against independence, the Transparency Act. So how do you marry these two things of saying we want more cooperation here, but we want to involve Congress, and maybe that doesn't want that so much?
Larry's going off to the game. It's pity he's gone, because actually he would have thought about this as much as me. If you, I don't blame him for going for the game, by the way. I expected to have an empty room by now. If you start explaining the way the world works in the midst of a crisis as a policymaker, you have left it too late. You have left it too late with the public. You have left it too late with your Congress, or with Parliament. You have got to be as open and as truthful and as complete as you can possibly be about the way the world works. And so when Chris Dodd said to me, we know we're tracking in part G20 policy, what you're all doing, but we can't talk about it now. One of the reasons I didn't disagree with him was because we were there and then, and this had got to get through. But I do think that in my own country, and here, and in all the other leading countries, we did too little before the crisis to talk about the significance of the international agreements. We didn't hide them, but we should have more actively talked about them. That is easier said than done. It is the most natural thing in the world is for the legislature, again, Parliament as well as Congress, to think that the things that they control are the most important things in the world. So most people in Europe think the debate about the Volcker rule is just, a bit silly. I mean, it's not terrible, but it doesn't matter that much. Most people over here think the debate in the UK about Vickers ring fencing is a bit silly. It's not terrible, but it doesn't matter that much. But the core of the program is shared. But each legislature becomes and political community becomes incredibly attached to the thing that only they are doing. And I tell you, it's incredibly tempting to kind of indulge the political elected people in that. And I've ended up thinking that, and I thought a bit while I was in office, that actually you have almost a moral responsibility to ensure that these people understand the world is as it is. So with the swaps, the United States of America cannot expect, or no country on earth can expect, their currency to be the dominant reserve currency without their currency being used elsewhere in the world. So either the rest of the world is going to hold a huge amount of currency reserves and build them up, which will push down the world real interest rate and give rise to the problems that Ben Bernanke has eloquently described, or alternatively, people are going to rely on borrowing from the world reserve currency issue during crises. And my country was completely familiar with that when sterling was the world reserve currency. And leaders of the Federal Reserve have got to find a way of saying that, not in the tone that I just said it. I'm not an office holder, and I'm certainly not an office holder here, but finding that in a way where people think, yeah, actually we think it is a source of our power as the United States of America for the dollar to be widely used. And these swap lines aren't something terrible invented by the Federal Reserve as a plot against the American people, but actually are a corollary of the dollar being the hegemonic currency. But if you try and do that in the midst of a crisis, you will not be heard. You have to do all the important things during financial peacetime or in the security field during actual peacetime. And that, that's part of what it is to be a top policymaker, not watching the innards of the unemployment data.
Good. I think with that, Paul, it being what time it is, and indeed some people have left for other reasons, I want to thank you very much. This has been an extraordinary both lecture on your side and then discussion from the group here. Thank you very much.